So, the topic I have for you guys today is really what you need to know about Bitcoin and cryptocurrency in order to help best explain it to your clients, right? And what I want to do is provide a basic framework for understanding so you're able to speak intelligently on the subject and kind of be prepared for the conversations if or when they come up. So, as we begin, I want to clearly state here that I'm going to keep my bias to a minimum and I want to keep things very objective. So, let's forget about the bulls and let's forget about the bears and let's really focus on what's important here, the proverbial elephant in the room. And that elephant I'm referring to is Bitcoin. So before we dive in fully, there are a few things I want to go over quickly. If you see Bitcoin with a capital B, this is generally referring to the Bitcoin network, the blockchain, the software itself. So it's really referring to the entire ecosystem. But if you see Bitcoin with a lowercase b, I'm referring to the cryptocurrency token or the monetary unit itself. And when we're using Bitcoin, we're not restricted to whole number amounts. So like the dollar has cents, Bitcoin has Satoshis. It's just more divisible. And it's important because, again, when we refer to sending it or buying it, this can all be done in fractional amounts, divisible down to about 8 decimal places. And then finally, you may see the term BTC, and this is just a common acronym or a ticker symbol, what have you. So with that, let's get started here. Now, again, the goal I have today is to help you guys to understand how to best explain Bitcoin to your clients. And I want to do this in a way that avoids the techno speak that can quickly become confusing. So let me start with a simple introduction by breaking down what Bitcoin is by examining 3 general concepts. Bitcoin can be best understood by thinking of the concepts of trade, ownership, and trust. And when I say trade, I'm referring to the fact that people use Bitcoin to trade digital tokens directly with each other, voluntarily. And with ownership, individuals have complete control over these tokens. You have complete authority over your Bitcoin. They're not sitting inside of a bank account. And when it comes to trust, there are 2 important components. First, Bitcoin requires no trust to use, but rather everyone is able to verify their own transactions. And the Bitcoin network is the most trusted or the most secure network that has ever been created. Now, the simplest analogy that's helpful when exploring Bitcoin is to understand it like a bank wire transfer. So with a wire transfer, the sender is pushing payment to the receiver. And this payment moves really fast across a large distance. So you can send money overseas much quicker than having to deliver it by mail, and with a greater degree of assurance knowing that those funds are going to arrive. And there's a transaction fee associated with this because there's a cost to sending that money across the distance, as well as the third-party risk assurances of doing such. And because of this cost, bank wires, they're really not ideal for small transactions. Yet they're great for large transactions because of that high degree of settlement assurance and, well, it's quite fast. Bitcoin can be thought of in this way. When you're using the Bitcoin network, we can send large amounts of money across great distances, and we can do so very quickly with perfect settlement assurance. In fact, with Bitcoin, these transactions can be settled in less than 10 or just about 10 minutes. So I can send $1 million to somebody in Zimbabwe. I'm not sure why I would want to do that, but theoretically I could. And this could arrive as fast as 10 minutes. And I know the money's going to arrive. So with that being said, I'd like to take a moment to talk about what a quick elevator description could sound like. Essentially, this is a very helpful way to tell somebody what Bitcoin is, for example. So Bitcoin is a scarce digital token owned and traded by individuals through a new technology known as a blockchain. And this technology works by economically incentivizing participants to do the right thing and to act in accordance to their best interest. It doesn't require trust, but rather it allows participants to verify their own and others' transactions. And most importantly, there will never be more than 21 million Bitcoin in supply, making it the first example of a provably scarce digital resource. Wait, but what is Bitcoin, more simply? Well, Bitcoin is simply computer code, so it's freely and openly available in open source. Anybody can download it and choose to run the software. there are really no barriers to entry. You just simply need an internet connection and the computer. But what are Bitcoins? Well, Bitcoin are tokens essentially that are associated to the software. And again, we call those Bitcoins. Transactions of these tokens take place between individuals and are recorded on a public ledger, the blockchain that I just referred to. And this network of computers running the software all over the world is what we call Bitcoin, or the Bitcoin network. And an easy way to think about the blockchain, it's kind of like a fancy shareable spreadsheet that everybody has copies of and that's simultaneously updated. So the next point here really is, why is Bitcoin king? What differentiates Bitcoin and the other cryptocurrencies? The simplest way to explain this is to just understand that Bitcoin is by far the leader. So Bitcoin has been attacked by over 4,000 different projects. They're all trying to compete to be that one medium that we choose to communicate value across a digital space. But Bitcoin has beaten them all, hands down. We have about a 70% market dominance roughly today in terms of Bitcoin versus all of the other cryptocurrencies. So what makes Bitcoin different? What really differentiates Bitcoin from the pack? Well, it all comes down to market dominance and liquidity. So again, Bitcoin being the market leader in terms of the entire crypto economy, which is approaching nearly $1 trillion. It has somewhere around a 69 to 70% dominance, and this dominance has greatly contributed to Bitcoin being the most liquid cryptocurrency. And when I say liquidity, I mean the number of people able to transact, the number of businesses building products on it, the number of places you can buy it, trade it, sell it, the entire ecosystem in terms of peripherals. It's really what gives Bitcoin this huge advantage when it comes to that liquidity. And because of this, it's much more secure. And I'll get into that in a moment. But this $650 billion market cap that Bitcoin has is just a huge amount of money. And that for any one person to try to influence would obviously take quite the investment. And on top of this, Bitcoin has no marketing department. And this is really, really key because most of the other cryptocurrencies, they're really driven by hype machines. They're driven by high dollar spends to try to acquire users and to get users to try to, use their proprietary cryptocurrency. Plus, these other cryptocurrencies generally lack liquidity, and they lack the market cap to truly be secure. Many of them have centralization concerns, so they can be thought of more like individual companies, not decentralized like Bitcoin. And because of this, again, they're all fundamentally less secure. You can think of it simply. The smaller the market cap, the more easy you are to be influenced by any one person or one entity. It's really important when you look at Bitcoin to understand that it's the king and the leader in the space of cryptocurrencies. Now, there are a couple of technical concepts in terms of how Bitcoin works, but I really want to focus on the useful qualities real quick. And don't let these confuse you too much at first. Just try to take them at face value. So Bitcoin is provably scarce. There will never be more than 21 million Bitcoin. It has a fixed supply schedule. And it provides for rapid settlement in transactions. So this settlement occurs anytime that you'd like, 24 hours, 7 days a week. It's completely open and an accessible marketplace. There's no market close, there's no waiting for business hours. And also it has this really unique quality, which is a finality in settlement. So there are no chargebacks. There's no need to trust a third party. Everything is done peer-to-peer. There's no trusting a middleman service or a bank, all to carry out or guarantee your transaction because, everyone can verify it themselves. And this is all possible because of its decentralized nature. So the fact that nobody controls it, and you have this innovation called the blockchain, which essentially facilitates this all by incentivizing people just to do the right thing, what it amounts to is a really technical or complex system with very simple or reasonable incentives. It comes down to economic incentive and game theory. It's all really quite impressive. And again, all of this is occurring outside of the current financial system. So there are no jurisdictions in Bitcoin.
Hey, Alex, could you, as far as the act in the best interest and in the incentive to act in the best interest, I guess that point is hard for me to understand. Can you just elaborate on who has the incentive to act in the best interest and how that works?
Sure. I'd love to help you to understand that. I'm gonna try to do it in a minute here, and if not, we can revisit it in the Q&A period. So if you want to just write that down, we can revisit it. But real quickly, the incentives that the blockchain has, it's a security mechanism. So you have these miners, and these miners are essentially verifying all of the transactions that everybody has. And the incentive that I'm referring to is something called the Bitcoin block reward. And this block reward is the creation of new Bitcoin into the supply. So every 10 minutes, these miners are working together to solve a very complicated math problem. And when they solve that problem, they're able to batch up those transactions into a block to earn the reward. So this is, again, where it kind of gets more complicated, and I want to try to keep things simple. So just kind of take it for face value right now, and we can revisit it in the Q&A, and I can kind of elaborate a little bit more on that.
Sounds good.
So one of the reasons why many, people are attracted to Bitcoin is this concept of independence. This is primarily why you'll see a lot of libertarians that love Bitcoin. It's really because it brings the control back to the individual. So it's all about individualism versus collectivism and having the freedom to express yourself in means of a monetary communication or exchange of value or store of value. All of this independent. Finally, Bitcoin is a true bearer asset, which means if you own Bitcoin and you control your keys, you own the asset. There are zero liabilities associated to it. So what that looks like is no third-party interventions. Nobody can freeze your account or prevent you from making a transaction. And this is all really why it's useful. So what's different today? What's going on with Bitcoin today, and why is there so much price action and volatility, and why are people talking about it? Well, this kind of comes down to four things in my opinion. There's a staggering increase in adoption, and that's continuing to grow. There's growth in the institutional interest. There's major growth in retail brokerage demand. And there's essentially a maturation of Bitcoin that's occurring, and it's accelerating at a very rapid pace. So let's talk about adoption. If you see this chart here, you can see adoption increasing. So what this chart shows is essentially the last 4 years, roughly, of wallets that are holding $10 or more worth of the equivalent in Bitcoin. So you can see in 2016, we had just under 2 million individual wallets that were holding this amount. Now, in 2020, we're over 18 million. And today, that number is well over 20 million. So adoption is increasing at a staggering rate. And as we know for the network effects in digital space, the more users you have using something, essentially, the value of that network will increase exponentially with the number of participants in that network. And this is an abstraction of what we call Metcalfe's law. So the next thing I want to look at here is the institutional growth side of things. And I'm going to do that by looking at a proxy of the CME or the CBOE Bitcoin futures and open interests for options. So why this is important again is that we're able to see that the same trend going up and to the right for institutional activity. And what these derivatives and futures and options contracts are allowing is kind of a double-sided value for the Bitcoin ecosystem. Fundamentally giving sophisticated investors more tools to hedge risk or to get exposure, but also helping the Bitcoin producers as a way to access these products and hedge against their own production risks, those miners that I was referring to before, Alex. So you're seeing this double-sided network effect that's essentially increasing the flow of capital and allowing the entire ecosystem to develop and mature in ways when it previously couldn't have prior to 2018. And again, the CME and CBOE derivative markets are extremely regulated. So with that comes more laws and regulations and the SEC, all having a better understanding of what Bitcoin is. So finally, we're seeing major growth in retail brokerage demand, and that's illustrated here via the GBTC Bitcoin Trust Vehicle. This is essentially a stock-like vehicle that's sold in the over-the-counter markets. And what it does is it sells you shares of their product, and they go out and they buy Bitcoin and give you a fractionalized percentage of that. So this chart has that same sort of positive trend. And it doesn't even include the last few months from November to now, where we've seen substantial inflows of activity. Again, this speaks to the demand of retail brokerage customers that are looking to use traditional investment vehicles, like brokerage accounts, to buy Bitcoin. And as of January 13th, GBTC holds 67% of all the Bitcoin held by any publicly traded companies or that are offering ETF-like products. In fact, GBTC holds 2.73% of the entire supply of Bitcoin. So what does this mean, right? Well, there's clearly interest from the broad base of retail customers that are looking towards traditional investment vehicles as a way to get into Bitcoin. And this massive growth in GBTC has basically been a proxy for the demand that an ETF product might generate or might serve. Well, that's if they ever get approved for the marketplace, that is. So finally, to wrap this section up, we look towards the maturation of Bitcoin being accelerated. So with the adverse consequences of the coronavirus crises and the increased money supply that the government is stimulating the economy with in response, we're seeing the adoption of Bitcoin continue to grow at a staggering rate. So people, it seems, are actively looking for this alternative investment vehicle. And that, in combined with the development of the regulatory frameworks and the growth of the institutional and retail products, we have this very unique multi-sided network effect forming, meaning the users and the miners and the developers, every single one of these groups, they're all growing and they're growing really fast. So there's something that Anthony Scaramucci said, which I think is interesting. He runs a $7.5 billion hedge fund and just launched a Bitcoin investment fund the 4th of January, actually, this last week. And he put it like this. He said, institutions are more confident at $27,000 per Bitcoin than they were at $400 per Bitcoin, say in 2014. And this kind of illustrates the point that there's a lot more stability in the marketplace. And there's a lot more stability in terms of people getting educated on Bitcoin, getting more information, and being able to make decisions based on that in terms of allocating their resources or making speculative investments in this asset class. Finally, we have, according to the Bloomberg Crypto Outlook from last April, that we're seeing Bitcoin divorcing more from equities. So it's becoming somewhat of an uncorrelated asset. And it's moving a little bit more towards something like gold, which is traditionally used as a reserve asset or a store of value for companies looking to hedge against things like inflation risk. So how do you buy Bitcoin? Well, there are essentially three ways to buy Bitcoin. You can buy it on an exchange, you can buy it indirectly through an app, or you can use a third-party partner or a partner company. So the first and best way to buy Bitcoin is by using an exchange. And an exchange is very similar to an online brokerage account. You're going to sign up with the exchange and go through a KYC AML process, which is Know Your Customer Anti-Money Laundering, usually involving giving them your driver's license or your social security number, and they'll get the ball rolling for you. Once that's done, you're going to go ahead and connect your bank account with the exchange and simply transfer money from your bank to the exchange. Now, once you have money on the exchange, then you can start to use their brokerage platform to purchase Bitcoin directly at a quoted price, or you can use their trading platform to go out into the marketplace and execute a buy order. Either way you choose, the Bitcoin will arrive in your exchange account inside of an account wallet. Now, an important thing to note here is you don't necessarily or completely own Bitcoin at this point. You kind of quasi-own it. You're allowed to buy it, you're allowed to sell it, and in fact, you can send it wherever you'd like, but you don't actually own the underlying keys associated to it. However, you will obtain those keys when you do withdraw the Bitcoin from the exchange wallet, either by taking self-custody or by using a custody partner. So generally speaking, it's kind of risky to leave your Bitcoin on an exchange because that exchange is in control of your Bitcoin. And while it's a rare occurrence, let's say they got hacked, or if somebody got into your account somehow, your coin could be in jeopardy. And this is why understanding custody is so fundamentally important. So to sum things up, you can sign up for an exchange like a brokerage account. You verify your identity, attach your bank account, and then you can go and buy Bitcoin. And the best exchanges are US based, like Coinbase or Gemini or Kraken. There are also apps that you can use to buy Bitcoin directly on your smartphone. So there's the Cash App, there's PayPal, and there's Robinhood, for example. And all of these have different advantages. Generally speaking, there's a relationship between the convenience or the ease of use and the underlying risks associated to it. The Cash App is the most similar to an exchange in that you can actually withdraw your Bitcoin from the Cash App, unlike PayPal and Robinhood. However, they have a $2,000 per day or $5,000 per week withdrawal limitation. So for someone looking to just buy a little bit of Bitcoin and then withdraw it, the Cash App is perfect. Also, side note, the Cash App is owned by Square, which is a huge payment processor, founded and owned by Jack Dorsey of Twitter. So it has a very large user base and a high degree of security to it. With Robinhood and PayPal, on the other hand, you're not actually buying Bitcoin. What you're doing is you're buying indirect exposure to Bitcoin. So with Robinhood and PayPal, they go out and they buy Bitcoin and they hold it. And then they give you a representation or an equivalency of that Bitcoin denominated in US dollars. So while that gets you exposure to buying Bitcoin in terms of the price movements up and down and how that impacts your account balance, you can't withdraw any Bitcoin from Robinhood or PayPal. You can only withdraw dollars. So they're all dollar settled. And with that comes a little bit more uncertainty also, because you're trusting Robinhood and PayPal to custody your funds, and you're also kind of at the mercy of these companies. So if they don't like what you're doing, they could freeze your account.
Hey, Alex, just to jump in there. So
Yep.
for Robinhood, PayPal, you just get exposure. So you couldn't, if you want to put $100 on the Packers game this weekend, and you own some Bitcoin in Robinhood, you can't send it to your online gambling site, right? You can only just buy and sell and get exposure within that app. You would need an exchange to do that.
You would need the Cash App, or you'd need the Cash App or an exchange to actually withdraw that Bitcoin from those services.
Okay, and then send. Okay, got it.
So Robinhood and PayPal are cash settled, kind of like the derivatives marketplaces. The CBOE and CME are cash settled. They're not exchanging Bitcoin. They're just exchanging a representation. And the other thing about Robinhood and PayPal is they have claimed to have zero trading fees. However, what they don't tell you is that when you buy Bitcoin, they do it at a margin between the current price and the price that they quote you. So they're effectively making their fees on the back end. Go figure, right? Back to buying Bitcoin on an exchange or with Cash App, you can remove the Bitcoin from that exchange or from that Cash App and send it to your personal wallet or wherever you'd like to send it. Maybe you're working with a custody partner. So nobody can stop your transactions or freeze your transactions in that regard. Finally, there are companies like investment partners. These are the River Financials or the EagleBrook Advisors of the world. And these companies offer a variety of different services that speak to kind of the needs that people have to help them buy and custody Bitcoin. And I think this is really interesting because these companies are popping up left and right, and there's just an incredible amount of growth in this space too. And as a matter of fact, I think it's vital to the ecosystem. I think it's something that's really necessary and helpful. Especially getting people exposure while they, don't have a lot of experience. Because when it comes to Bitcoin custody, which is our last topic for today, there are many ways to store and to own your Bitcoin, and it can get really complicated and it can get really confusing for people. And there's a lot more risk associated to it, frankly. So let's finish up here today with custodying Bitcoin. Now, this is a really important concept. So if you choose to self-custody Bitcoin, as in buying on an exchange and withdrawing them to your private wallet, for example, your phone or a hardware wallet device, you're effectively now making a huge leap in terms of responsibility and ownership. You now have the keys, which means that you and only you have both the control and the risks associated to it. This ownership comes with some very important considerations. Which wallet should I use? How do I keep my keys safe? What happens if I lose my keys? These are all really important questions, and they require taking time to explore and practice and learn. And this is why I recommend, strongly recommend, is to use a custody partner when you're just getting started. Because with self-custody, you can't make mistakes. If you lose your keys, you lose your Bitcoin. It's a bit like carrying a loaded weapon with the safety off. Now, as long as you know how to properly handle it, there's very limited risk. And generally, you're actually safer for having it. But if you slip up, you could potentially suffer some pretty rough consequences. Also, because of that finality and settlement I mentioned earlier, everything you do with Bitcoin has to be done perfectly with no mistakes. And this applies to any time you're conducting a Bitcoin transaction. A mistake in the address or the amount that you're sending means your transaction is either invalid or simply gone forever. Now there's a little leeway here, as a typo generally may result in an invalid address, which doesn't get approved by the blockchain because it's invalid. However, if you send it to the wrong address, for example, you're out of luck. There's no reversing transactions. Now, this is where some people might get a little nervous because there's no insurance and there are no do-overs. And ultimately, this is why the growth in the custody space is so important to the Bitcoin ecosystem, because not everybody has the level of technical acumen or are comfortable enough with the idea of, oh my gosh, I could make a mistake and lose my Bitcoin. So this is why custodians are really important, especially for new users. As I mentioned, the River Financials or the Eaglebrooks, the Coinbase and the Gemini custody options, they're effectively helping new Bitcoiners to participate while still having that time to adjust to the learning curve. And this is so important. Eaglebrook specifically offers a great new product called an SMA, or a separately managed account. And these are specifically designed for this scenario. With these SMAs, they essentially allow registered investment advisors to partner with them for a fee, and then they will go buy and sell, hold in custody, and do all that Bitcoining for your clients. And that will all be securely maintained in their own individual SMA Bitcoin account. So this is a really great example of how the ecosystems are growing from an institutional and retail perspective to help solve many of the nuanced problems that face new Bitcoin buyers. But the really important thing to understand with all this is that there are pros and cons of each option, and it all boils down to your individual preferences or where your comforts lie. Generally, there's a trade-off between ease of use and convenience that a custody option may offer, and the amount of risk that you're willing to take in trusting your Bitcoin to that third party. As well, the cost of ownership you're willing to absorb to have that peace of mind. So with that kind of wraps up my presentation here. We talked about a lot of stuff today, guys, and I just want to open up the floor and give you an opportunity to ask some questions, and hopefully I can do my best to answer those questions. And if I can, I'll certainly point you towards some great resources. When we're finished here, everybody can have a copy of the slide deck, and with this deck comes an appendix, which contains many common questions, some sort of interesting hot takes, and there's also a compendium of learning resources that I've created at the end, which can help anybody from beginner to advanced, walk down that trail of education. Anybody that wants to continue into the Bitcoin rabbit hole, what have you. And the final thing I'll say about this before we jump to Q&A is that the best way to learn something is to experience it yourself. So I'd highly recommend, if you're curious, that you just download a free wallet, you buy a small amount, say $20, and you conduct a few transactions to just see how it works. So I hope you guys got some value out of this presentation. And with that, let's go ahead and open it up to you guys.
So, Alex, I've got a question. There's a finite amount of Bitcoin that's ever going to exist, right? It's I forgot what number you said, but there's it's that finite market of total Bitcoin that will ever be released into the system, if I'm putting that the right way.
Mm-hmm.
And then, if I'm understanding this, one of the things that makes the Bitcoin system work is the people and the computers that are mining the Bitcoin by certifying all the transactions through the the software programs. And you can like get rewarded by earning Bitcoin by participating in that process. Am I understanding that properly?
Absolutely.
So
That's correct.
If there's a finite amount of Bitcoin to ever be introduced into the system, and one of the key incentives to secure the system is the people mining for the Bitcoin, is there ever a point in time, however far off in the future, that changes? I mean, that there's not Bitcoin available to be mined to create the secure structure that underlies it?
Yeah, that's a fantastic question. So let me help you understand how the mining process works with respect to this fixed supply. And 21 million Bitcoin being the total fixed supply that will ever exist. So as miners are verifying the network on the blockchain, the subcontractors of the system, what have you, they get compensated in two distinct ways. The majority of which is something called the block reward, which we're referring to. So the creation of new Bitcoin into the ecosystem. And the second way that they get compensated is via those transaction fees that are similar to like the bank wire transaction fee. So they're getting paid in two ways, the block reward and a small nominal subsidy from each individual transaction. And the supply schedule of Bitcoin is kind of complicated, but bear with me for a second. You essentially have a 4-year halving cycle that occurs. So starting on January 3rd of 2009, and then 4 years from then, we had our first halving cycle. So the first Bitcoin reward every 10 minutes was 100 Bitcoin. So every 10 minutes, the miners worked and they got 100 Bitcoin for verifying the transactions and including them inside of a block. And the term blockchain is each one of those blocks existing sequentially all the way back to the complete history of the first Genesis block. So in 4 years from that date, after, I guess, 2013 sometime, the block reward decreases in half. So the supply schedule cuts itself in half every 4 years and creates an exponential decay out until the year 2140. So a pretty long time from now in terms of new Bitcoin getting created and entering the supply ecosystem. So what this does essentially is it kind of functions as to reinforce the inherent scarcity of the Bitcoin ecosystem. And theoretically, when that supply becomes zero, or when the total fixed supply is into the marketplace, the miners then will be purely paid or compensated for verifying the transactions. So theoretically, over time, the price of Bitcoin is kind of designed to increase in value. And with doing so, the transaction fees will then serve as sort of the theoretical incentive for the miners to continue to participate and continue to verify transactions. So does that help you to kind of understand a little bit?
Yeah, that does. That was a good explanation. So the system relies on those miners and like companies that are engaged in doing that, right? To do it, like, what's the theoretical risk of people stopping doing that? I don't even know if that question makes sense. I mean,
it makes sense. Yeah.
Or are like the exchange companies involved in mining as well? Is that how they, or is it just individuals primarily?
Yep. And so this is sort of the fantastic thing about, I refer to it as an autonomous incentive system. So every 10 minutes, that block reward is essentially all the miners working independently to resolve all the transactions. And anybody can be a miner. I could download the Bitcoin, software, and I could become a miner. Granted, I don't have I don't have the hardware required to do so. And the incentive for miners, what if they stop doing it? Well, they're not going to stop doing it because there's the economic incentive of this reward or this distribution or creation of new Bitcoin. And those Bitcoin people feel have value. And so there are these things called mining pools that exist. So the exchanges are not involved in mining at all, but there are these entities which are called mining pools, which basically work by creating a conglomerate of a bunch of different people individually on their own, spending their computational resources together to try to solve or to earn that Bitcoin reward mechanism. So while there are big players that are substantially contributing to the overall hash rate or the amount of energy that's being spent to, solve each block, there are no, syndicates, and there is no controlling mechanism, as it's all done independently.
My exact question I was going to pose to Alex as well. So, and it's interesting, I have one of my firm team associates' husband mines Bitcoin.
Oh,
cool.
And he apparently has a tremendous computer setup that costs him, hundreds of dollars a month in energy cost.
Yep.
And he is mining Bitcoin. So now I understand a little bit more about what he is in effect doing. And your explanation earlier, Tim, was great. And I could see that as they run out of the $21 million Bitcoin, they can't incentivize them that way. They get paid in exchange sort of fees. So what are they checking? When you say they're verifying transactions, what are they doing to verify transactions?
Sure. Great question. And I love that, you have somebody that that's a miner, because that just illustrates how open and sort of ubiquitous it can be with regards to what they're doing, right? So the way that the mining process works is anytime anybody sends a transaction, let's say I want to send you some Bitcoin, I'm going to use a service like a wallet or the exchange or whatever the service is to create a transaction between two people. That's the peer-to-peer nature of it. And when I do that, I'm broadcasting that transaction to the Bitcoin software. And so what the software does is it has a big list of these transactions. It's called the mempool. And that mempool is basically a bunch of transactions that are unconfirmed yet. They haven't been verified yet. And the way that essentially the software works is through a mechanism known as proof of work. And this proof of work mechanism is the security model that allows the blockchain to kind of work autonomously in terms of people verifying those transactions. So proof of work meaning they're spending computational energy. They're spending real thermodynamically secured energy, electricity, to solve an incredibly difficult math problem. We're talking, 17 decimal places of difficulty, if you think about how exponentially difficult that would be. And this is the security mechanism that allows this block reward to be distributed to the mining groups. So your friend has probably some hardware machines, and those machines are designed specifically to solve this one problem. It's a SHA-256 advanced encryption technology, and they're trying to essentially by brute force break that encryption. And when they're able to break that encryption, collectively all the miners, they're able to say, aha, we've solved the solution. And because the blockchain exists as this sequential linear history of every single transaction from January 3rd, 2009 until ad infinitum, they are spending that energy to verify the entire integrity of the chain. So you know that if the previous block was approved and the block before that the system remains intact and verifiably honest. And again, this is why it's an open system and why it's a completely auditable and transparent system, as you're able to see the entire history and you're able to see everybody's transactions as they get verified by the network. Does that help a little bit?
That helps a little bit. And so you talk about how some of these miners are sort of grouped together. Do they know they're being grouped together? Are they actively part of a known group, or are they working independently? And do they realize they're part of a group, or are in the end they only get a small share of whatever coin?
Precisely.
Okay.
Yep. So I can sign up as an individual because I can't compete on my own because the network has grown so much. I sign up to a mining pool, and that mining pool takes the amount of hash rate that I can produce with my hardware and gives me a percentage of the amount of energy output that I'm putting into the system. So back in 2010 and 11, you could mine Bitcoin on your old gateway laptop or whatever that's, sitting in the corner because it didn't take a lot of computing resource. And in fact, a lot of people are very wealthy individuals now because of this hobby that they had, generating this internet money on their crappy computer in the back room. It's grown today, 12 years later, into this very low margin industry that requires, substantial investment if you'd like to get the most current technology.
Yeah, and it strikes me that the people that were early in on this got the better payoff in a sense.
They did. They
Back to
did.
your example of 100 Bitcoin to be divided, and without needing the energy and the equipment to do it, now they're making more of an investment and are getting a smaller piece of the pie, although maybe the fees make up for it, like you said.
Yeah.
Well, and that would be in the start of any like good investment. Is the early people, reap a lot of the rewards.
Sure.
Which I get. Alex, I have one question, because it's okay. Dumb this down for me. So you get a hard math problem, and verifying the all the blockchain from the January 3rd of 2009. How does that come together? So you got these miners verifying this hard problem, and that somehow verifies the entire blockchain. That was one question. And then two, is it they get that block reward every 10 minutes? Is that why it takes about 10 minutes for the average transaction to take place? So
Yep.
A couple questions there.
You got it. Absolutely. To address the latter, the 10-minute interval is when the new block is created. And when the new block is created, the reward is given. And the creation of that new block is the verification of all the transactions that have been batched into that block.
Interesting.
And to answer the former, the history going all the way back to 2009 has this integrity to it because each block is verified sequentially. So there's no break in the chain. So all of these miners, they're working on that one block at a time, block by block by block. And this is a little bit complicated, but think about it like this. Because it requires so much energy, if you look up the statistics, the amount of Bitcoin, the energy use of the Bitcoin miners is huge, like more than this country of Ireland, or, it's a massive amount. This cost to process and verify those transactions is so inefficient. It uses so much energy that to make edits or changes after there's millions and millions of watts that are being spent, it isn't economically viable for somebody to go and try to edit the blockchain 1 or even 2 blocks back because it requires so much energy that economically doesn't make sense. And this is how some of the game theory or the economics are sort of simple in concept of to how they address this autonomous verification system. Very complicated technologies, very simple psychological principles.
I was going to ask a question regarding regulatory risk.
Sure.
Certainly, lots of businesses have regulatory risks. What are the risks that Bitcoin has in terms of regulations and government getting their hands in things? And if you could just give us a little feel for that.
Absolutely. So from a regulatory standpoint, the risks that exist are mainly price volatility risks. So the government essentially has no authority to shut down Bitcoin. It can choke Bitcoin, right? It can shut down exchanges. It can say you go to jail for 20 years if you're caught transacting in Bitcoin. But in terms of actually controlling the system, it exists independently and autonomously. So the greatest sort of regulatory risks are the tax treatment. So how is Bitcoin going to be taxed, and a potential criminal risk for use or for the facilitation of the network. So what I've shown you here is the list of the pro-Bitcoin government officials. So you can see there's about a dozen representatives and senators that have, are on record as pro-Bitcoin. many of these being more libertarian leaning Republicans and people that are a little bit more interested in keeping the power in the individuals and again, less of the collectivism or less of the big government ideology. The state of Wyoming is actually sort of leading the way. It's kind of like the Delaware of the traditional sort of business world. So the state of Wyoming's Senator Cynthia Lummis is actually, one of the biggest, call them Bitcoin bulls in terms of the government itself. And so what the state of Wyoming is doing is they're developing the infrastructure that is necessary to help to work with regulation bodies and the regulators in order for the system to mature more. So just this last year, in the last few months, the state of Wyoming created a state chartered banking. They got a state chartered banking license for companies like Kraken to come into their state and begin developing banking services. And from a regulatory perspective, they're doing so, and I think there are about 13 different bills that have been brought up, and many of them passed, that have to do with creating the definitions that are required from a legal side. So you've got people working on developing the frameworks and the laws and creating, like for example, Representative Warren Davidson of Ohio created the Token Taxonomy Act, and Ted Budd of North Carolina, the Cryptocurrency Tax Fairness Act and the Virtual Value Tax Fit. And a lot of these regulations are sort of preempting what we call these central bank digital currencies, which is probably going to be the next direction that our current financial system goes towards in terms of creating a digital dollar and so on and so forth. So a lot of the regulations are currently being created within the Bitcoin ecosystem as it pertains to this. But just know that from the SEC to several of the other entities that exist to create regulations, that this is something that is currently happening right now. And there's a lot of resources being put towards that, to making sure that people are doing things the right way and doing so legally and by the court of law.
Perfect. Thank you.
Yep.
So in case I have to get off here real quick before we terminate, how are we going to get access to this presentation that Alex promised us?
Yep. I'll make sure I get it to Alex and share it with all of you guys individually. So this presentation is open source itself. So any of you guys can take this and you can practice it. I've got notes in there. You can speak it just like I spoke it, and you can share it with your teams. You can share it with your colleagues. You can share it with your friends. That's the way Bitcoin works, is things are open and transparent and shareable. So that's my sort of parting gift with you guys, should you call it that, if you are interested.
I guess I had one more question. I'm really interested in the energy consumption requirement that kind of underpins this whole thing. And are there studies, or are there people working on this idea of, if it's already requiring the energy usage of a small country, and Bitcoin is still relatively in its infancy, I suppose, in terms of like total usage. Mm-hmm. What does it look like 100 years from now in terms of the required energy consumption to keep the system afloat? I mean, it reminds me of how, computer technology came along, and that was great, and then it became really cost prohibitive and impossible for people to have servers and everything else, and that pushed us to a move towards cloud computing and the like. I mean, is there similar discussions around Bitcoin technology?
Absolutely. That's a great question. And it's one of the current topics of discussion among the community in terms of how we're going to address that, right? Because that is the crux of the system, is the proof of work mechanism. That is using physical energy to secure the network. And a good way to think about it is I think it's about 39% of Bitcoin's total hash rate, which is the total amount of energy being used, is generated via sustainable resources. So wind farms, solar farms, and hydroelectric power. So that's today, with the amount of energy that's being used today, roughly 40% is coming from sustainable resources. So as sustainable resource energy is continuing to progress and we're developing new technologies and innovating in that space, simultaneously you'll see the Bitcoin ecosystem gravitate towards that, because of the incentive to get cheaper energy, right? To have more efficient access to energy is going to make more people want to mine and contribute those resources. So you can kind of think of it in a similar way to kind of the sustainability curves that exist in terms of getting us away from some of the more pollutant forms of energy creation, whether that's insert your oil or gas or coal or whatever it can be. The other really fantastic thing and the fascinating part here is we haven't quite seen a lot of it yet, but I don't know, there's a handful of companies that are really innovating in this space. So they're taking like the gas. So there's a waste product when you're running a refinery. This excess waste gas gets burned off. And you can actually harness that waste gas and use that to create a fuel source for Bitcoin mining. Because essentially, the only thing that Bitcoin requires is raw energy output. So as companies are developing and innovating new ways to harness sustainable or previously attributed to waste product, you're going to see businesses be created around this that are incentivized to now take that excess energy and mine Bitcoin with it. So another good example would be a wind farm in the plains of Kansas or outside of San Diego, where they have different peak hours in terms of the energy need from the people that are being powered by it and the amount of wind that's getting generated by the earth. So as it becomes, again, more mature, as people are becoming more interested in partaking in building businesses in the mining space, you're going to see new innovations like solar farms that have more sunshine that aren't getting used by the population around it, contributing those excess resources to Bitcoin mining to make themselves more profitable. So again, there are economic incentives that are going to contribute to the innovation of the system and to help solve some of those problems that exist in terms of this huge amount of energy output that's going to be required to sustain this new financial system or this alternative financial system, all verified based on this use of energy.
Yeah, I just find it interesting. Yeah, it's fascinating.
Yeah, it really is.
We're just a couple minutes from 9 o'clock here. Does anyone else have questions?
I've got one more, Alex, because I'm cheap, and when I was looking into this a few years ago, if you're buying, so if you put cash, you link like a Coinbase account to your bank account, you fund it, and then to exchange and actually buy Bitcoin or any other crypto, there's a transaction fee. So if you put $100 in,
Mm-hmm.
You don't get $100 worth of Bitcoin up front, because when you do that currency transaction essentially and exchange it for the crypto.
Yep.
Do you have a sense of what that transaction fee is, and is it the same on, how does it compare on Coinbase versus like Gemini or PayPal?
Great question. Coinbase is the cheapest. Each individual company has a different fee structure, right? Because of however they're running their business. Generally speaking, I think Cash App and Coinbase are going to be cheapest from a fee perspective. Again, PayPal and Robinhood and some other entities will claim they have no fees, but you're actually, absorbing it on the backside. So I would highly advise, in terms of understanding and doing a little bit of research, is just to say, make the decision first. I want to experiment or I want to try this out. And then probably check out Coinbase. I think Coinbase is by far the market leader. I think they have somewhat of like a 80% market share in terms of US exchanges. So they're just, in terms of total volume, Coinbase has the most activity. But there's some side effects to that aren't necessarily great, because with that volume comes more saturation in transactions. And because of that, Coinbase will from time to time go down when there are these huge volatile price movements like we saw last week, where Bitcoin dropped by 20% and it caused all these traders to be executing these different exchanges. And eventually Coinbase reaches this throughput and they're like, we got to shut down for now, kind of like pulling the circuit breaker. So with that being said, I personally am a big fan of Kraken, because they also are the first exchange to have a crypto bank. So they're going to be creating some awesome products, from debit cards to lending services to interest-bearing accounts and that kind of stuff. And they're also considerably kind of the most secure, as they've never had any sort of hack. But you could also check out Gemini if you're into having the Winklevoss team on your side, who have been pretty successful in business and have a lot of really powerful relationships. So again, it's kind of subjective where you want to go, but in terms of cheapest, Coinbase. I guess I would just say one final thing is, if you guys are interested or want another, run through this presentation, feel free to reach out and email me. My email address is in the slide deck. If it's something you want to share or have another conversation, just email me, even if it's one-on-one and you want to, get real down into the rabbit hole. I've got answers to most questions. And if not, again, I can port you guys to where you can find some good resources. So thanks again.